Okay, so it is the 1st of September, and I want to use this opportunity to look back at the previous month's stock market performance and compare my portfolio against it, look at my dividend income, and a bunch of different metrics like that. So, okay, the past 1 month in the market has not been good. The S&P 500 is down 3.36%, and this is part of the larger downturn that we've been experiencing year to date. Coming to my portfolio and filtering by the past 1 month, I've definitely fared even worse. And to gain some more insights here, we can see that the growth sector and technology stocks in general have done the worst, down 6.5%. My more conservative dividend and income assets down about 2%, and then xyld is down about 4.5%. Now let's take a look at some of my core holdings on an individual basis, beginning with Divo. So here we can see the past 1 month, this is done pretty okay, only down about 1.5%, because Divo, of course, is comprised of dividend growth companies, which historically tend to perform better in more harsh economic environments. Now, when it comes to the dividend, their last payment, which is a monthly payment, was about 14.5 cents per share. Now, the thing is with Divo, their dividend has not been growing that much in the past 2 years. In fact, if you go back to a random payment in 2020, it was about 14 cents per share. So unfortunately, this doesn't buck the trend, but on a more short-term basis, it is better than the previous 3 months. Now, my next main income asset is jepi. And over the past 30 days, this is down 3%, which is almost double that of Divo. And that's simply due to the different strategies and approaches these two funds take versus one another. Now, the dividend has always been a strong suit of jepi, but unfortunately, they take a very long time to pay out, and we do not have any data for the month of August yet. Although I will say that so far this year during the downtrend, the dividend payments have been remarkably consistent, so it's pretty easy to guesstimate a range in which this dividend is going to come in at. My next income asset is BST, and this is a science and technology trust. And over the past 30 days, down 7.72%, getting absolutely slaughtered. Now, I still like BST. I think it's a great investment. It's just that in this market, it's getting absolutely crushed. But the dividend is a strong suit of this investment, coming in at a managed 25 cents per share. And my final investment is xyld, and this is down about 6% over the past 1 month. Now, the entire point of this ETF is to generate income off of the S&P 500, and last month in August, it generated 43 cents per share. Now, if we come to my brokerage account and go to the activity page, we can see my physical dividend payments from these various ETFs. BST gave me almost 30 bucks, Divo 24, xyld 49. Now, as mentioned, we're missing jepi for this month, but last month it had about 50 bucks. So I'm going to guess that for the month of August, jepi is going to be between 45 and 50 bucks. So that means my total dividend income for the month of August equals $150. Now, to zoom out and give you guys a macro view of the stock market, the most recent wave of red in the market is due again to the fear of rising interest rates. And this is mostly due to the Jerome Powell speech he gave at Jackson Hole, where he essentially said to the market that they should curb their enthusiasm. And we can see here that the market definitely heeded his warning. And on top of that, the Cleveland Federal Reserve President, Loretta Mester, said Wednesday she sees benchmark interest rates rising above 4% by early next year. And for the most part, markets were not previously pricing in a 4% interest rate by early next year. And on top of that, they're not predicting any rate cuts until at least 2023. So that's the current situation of the stock market and why this most recent price action has been happening. Now, personally, I'm going to be shopping for opportunities, and I think we're going to come back down and retest this low. I don't think we're going to break through it. Of course, it's possible, but if we do come all the way back down to this 350 level, to me, that's going to be a good buying opportunity. And another way to confirm that is to use the VIX. So historically, whenever the VIX is above 30 to 35, that has always given you outsized returns over the market. As an example, if you bought back in March 2020 when the VIX spiked to 66, you would have had fantastic returns. So personally, I'm going to use the VIX in combination with the S&P 500 retesting its June lows to identify good buying opportunities. So I don't mind having the market go down. It allows me to buy into my ETFs at cheaper and cheaper prices, and the whole time I'm enjoying nice monthly dividend payments. But that's just my take on the stock market. Let me know what you guys think in the comments down below. If you're still watching and enjoyed, I appreciate a like, go ahead and subscribe, and I'll see you guys in the next one.